In 2021, underwriting was a race. Fast money, aggressive rent growth, cap rates compressed like a loaded spring. But today, that spring is snapping, and it's snapping the knees of every operator who didn't evolve. The numbers are the same, the spreadsheets haven't changed, but the meaning behind them has. We're not in the same market, we're not in the same economy. So why are investors still underwriting like it's 2021? Because underwriting is no longer just math. It's narrative warfare. And most players don't know they're in a different game. So ask yourself this. If your rent growth projection is based off 3-year trailing averages, are you forecasting or reciting? Because if that isn't playing the same game anymore, and neither is capital. Let's be clear. This isn't a cyclical correction. This is a structural reset. And when the structure resets, the formulas collapse. Your DSCR, your IRR, your entry cap, they're all downstream of a new macro logic. The rules changed from when the Fed shifted from suppressing risk to exporting volatility. Insurance is up 45%. Taxes are revaluing bases faster than rent can stabilize. In some counties, reassessments are killing 80 basis points of yield in one stroke. Meanwhile, rent growth in key markets has flatlined, and some it's gone negative. And no one wants to talk about that. The assumption is that underwrote 2021 deals are just outdated. They're liabilities now, but models haven't changed. I see 5% annual rent growth, 30 basis point cap rate compression, refi assumptions based on term sheets from the last cycle. That's not conservative, that's suicidal. And here's a deeper danger. Capital doesn't just punish bad math, it abandons firms that refuse to evolve. The elite aren't running spreadsheets, they're running simulations. Because underwriting today isn't about what's likely, it's about surviving the improbable. Here's how smart capital thinks now. Tier 1 asset level stress testing. Can the deal survive a 20% vacancy spike? What if insurance jumps another 30%? Elite models don't just project base case, they run the edge cases. Worst quarter in 10 years, regional volatility, vendor strike. And they don't just guess, they simulate. Some shops are using Monte Carlo models to run 500 plus scenarios. Because in this cycle, resilience isn't a nice to have, it's the buy box. Tier 2, entry-level shock absorption, and here's where it turns surgical. What happens if 3 assets breach DSCR and your credit line tightens? Are your cross-collateralizations exposed? Do your waterfall mechanics spiral upward or drag you down? The smartest funds are designing capital stacks like war bunkers, redundant projections, legal firewalls, emergency upwind protocols, because once the liquidity goes, you don't get to renegotiate the structure. In Tier 3, narrative level positioning. This is the invisible battlefield. It's not just about spreadsheets, it's about narrative control. Capital is asking, what do you know in this macro? Where is the certainty? Where's the edge? If your pitch doesn't answer that, it's not a strategy, it's a story. And in this market, stories don't close. Because capital doesn't need another deck, it needs conviction. Let's go to the board. Institutional acquisitions dropped 61% year over year. That's not fear, that's strategy. Because Blackstone pivoted to data centers and industrials before headlines caught up. Starwood has stayed out of the Sun Belt since 24. CBRE reports cap rate decompression in 34 of the top 50 metros. CMBS delinquency in multifamily is up to 3.2%, the highest since 2013. But the number that should freeze you, Freddie Mac says 23% of mid-market operators missed DSCR last quarter, 1 in 4. And look closer, that number doesn't reflect bridge-only deals. That's across stabilized asset. We're seeing a downward rent revisions in markets like Phoenix, Tampa, and even Austin. Meanwhile, real-time leasing data from platforms like Funnel and LeaseHawk show tour volume is down double digits year over year in secondary metros. This isn't a headwind, it's a structural shift, and the market still hasn't priced it in. So what's smart capital doing? 1, assumption compression. They're pricing flat or even negative rent growth. Some models trust 5% year over year. The upside, that's gravy. Base case is survival. And they're backing that with real-time renewal data, not legacy rent comps. 2, duration hedging. 10-year fixed debt, no games, no short-term bridge. Yield takes a hit up front, but duration is the hedge and the moat. And here's the thing, they're layering interest rate caps on top of fixed rate positions to open early exit optionality without refinancing risk. 3, portfolio level structuring. The elite aren't just buying deals, they're building chassis, tax shelters, depreciation stacking, REIT overlays. They're modeling not just NOI, but synthetic cash flow. One fund restructured the 2021 vintage into a Delaware statutory trust just to unlock passive capital in a 1031 rollover. 4, tech-enabled expense efficiency. AI-driven leasing predictive maintenance, automated procurement. One national operator saved 1.2 million off OPEX just by syncing their renewal cycles with vendor pricing windows. Another slashed make ready times by 40% using a mobile first maintenance workflow. It's not just tech, it's velocity. 5. Off-market asymmetry. The best deals, they never hit the market. Smart buyers build buy boxes so precise, brokers call them first. They pre-underwrite 40 units every quarter, not to bid, not to train their instincts. When the right deal surfaces, they don't need a tour, they need a title report. So still underwriting like it's 2021, you're not underwriting, you're someone else's liquidity plan. Because this isn't about hunting deals, it's about tracking the migration of capital. But here's the thing no one's explaining. Underwriting, that's just the entry point. Next, we'll break down entity architecture, tax overlays, capital stack optimization, how the top funds can outbid you by 8% and still walk away better IRR. See, the next video isn't about theory, it's the blueprint, because in this game, the winners aren't louder, they're just built better. You see, the market isn't soft, it's sorting. The inefficiencies are gone. What's left is a skills market. The game is won before it's played. And let me show you why.